Are you dreaming of passive income that pays you while you sleep? We're comparing two titans today, VOO and SCHD. Which one is your golden ticket to more cash by 2030? Let's absolutely find out. Achieving true financial independence isn't about working harder. It's about making your money work smarter, leveraging intelligent strategies. And when we talk about making your money work for you, passive income is the ultimate goal. Imagine receiving regular payments directly to your bank account week after week, month after month, without lifting a finger. That, my friends, is the dream. Exchange-traded funds, or ETFs, have become incredible vehicles for this very purpose. They offer diversification, professional management, and impressive liquidity, all wrapped up in a single accessible package. Today, we're pitting two of the most popular and often discussed ETFs against each other in a head-to-head battle for your future passive income. VOO, the Vanguard S&P 500 ETF, and SCHD, the Schwab U.S. Dividend Equity ETF. Both are stalwarts in the investment community, championed by countless investors for their distinct advantages. But which one will genuinely put more spendable cash into your pocket by the year 2030? That's the critical question we're dissecting with careful analysis. We're not just looking at past performance, we're projecting forward considering their core strategies, growth potential, and specific dividend characteristics. Your decision between these two could significantly shape your financial trajectory over the next 7 years. Understanding their fundamental differences is the first crucial step on this journey. So, grab a notepad because we're diving deep into the mechanics of these investment powerhouses, preparing you to make an informed choice that aligns perfectly with your passive income aspirations. This isn't just theory, it's about real money, real growth, and real financial freedom, accessible to everyone. Let's begin with VOO. The Vanguard S&P 500 ETF is essentially a mirror of the S&P 500 index. When you invest in VOO, you're buying a tiny slice of the 500 largest publicly traded companies in the United States. Think Apple, Microsoft, Amazon, Google, the absolute titans of American industry. VOO's strategy is straightforward. Track the S&P 500 as closely as possible. This means its primary driver of returns is capital appreciation, the growth in the value of the underlying companies. As these companies innovate, expand, and consistently increase their earnings, their stock prices tend to rise, and so does the value of your VOO shares. While VOO does pay a dividend, its yield is typically quite modest, usually hovering around 1.5% to 2% annually. Its focus is not on maximizing direct dividend payments, but on capturing the overall robust growth of the U.S. economy's largest players. The power of VOO for passive income, especially by 2030, comes from a slightly different angle. If you reinvest those modest dividends, and more importantly, if the fund experiences significant capital growth, you'll simply own more shares. More shares mean more future dividends, even if the yield percentage remains comparatively low. Furthermore, if you plan to eventually sell a portion of your VOO holdings for income, the substantial capital appreciation historically offered by the S&P 500 means you'll have a much larger principal to draw from. It's a growth-first approach, where the passive income is realized either through modest but growing dividends or by selling a small percentage of a significantly larger portfolio. The key here is compounding capital growth. Over the long term, the S&P 500 has consistently delivered impressive returns, making VOO a powerhouse for genuine wealth accumulation, which eventually translates to income generation, whether through selling or increasing dividend payouts from a larger base. Now, let's turn our attention to SCHD, the Schwab U.S. Dividend Equity ETF. This ETF is built differently, with a distinct purpose, to provide consistent, growing dividend income. SCHD tracks the Dow Jones U.S. Dividend 100 Index, which selects 100 companies based on factors like sustained dividend payments, formidable financial strength, and excellent dividend growth rates. We're talking about companies that have a proven track record of not just paying dividends, but increasing them year after year, almost like clockwork. Think about names like PepsiCo, Coca-Cola, Broadcom, companies with strong cash flows that reliably prioritize returning capital to shareholders. The dividend yield for SCHD is typically much higher than VOO, often in the range of 3.5 to 4.5%. But it's not just about the yield, it's about the consistent growth of those dividends. SCHD has an exceptional history of dividend growth, often increasing its payout by double digits annually. This means if you invest in SCHD today, the income you receive next year and the year after is very likely to be significantly higher, assuming the underlying companies continue their strong performance. For someone prioritizing tangible, spendable passive income by 2030, SCHD presents a truly compelling case. The regular increase in cash flow can be used to cover living expenses, fund other investments, or simply provide invaluable peace of mind. The capital appreciation of SCHD tends to be more moderate compared to a broad market index fund like VOO, as its selection criteria prioritize dividend health over pure growth potential. However, don't mistake that for a lack of growth. Strong, financially sound dividend-paying companies often still grow their capital value. The primary appeal, however, is the direct, accelerating stream of dividend income. SCHD is a pure-play income generator designed specifically for investors who want to see their cash flow from investments expand predictably and sustainably over time. So, by 2030, which one pays you more passive income? Let's crunch the numbers and consider the pathways. If your definition of passive income is literally cash-in-hand dividends, SCHD has a strong historical advantage and a clear mandate to continue delivering. Its current dividend yield is significantly higher than VOO's. Furthermore, SCHD's dividend growth rate has consistently outpaced VOO's. For example, if you invested $10,000 today, SCHD would likely provide you with substantially more dividend income from day one, and that income stream would be growing even faster. Let's assume VOO maintains its average 1.5% yield, and SCHD maintains its 3.8% yield, both seeing moderate dividend growth, say VOO at 5% and SCHD at 10% annually. By 2030, the absolute dollar amount of dividends received from SCHD would almost certainly be greater than from VOO, assuming similar initial capital investment and no share sales. However, here's where VOO could potentially catch up or even pass SCHD, but through a different mechanism. If VOO experiences a period of exceptional capital appreciation, think tech boom scenarios, your number of shares would grow significantly, especially if you diligently reinvest dividends. While its per-share dividend might remain low, the sheer volume of shares owned could lead to a larger total dividend payment. Moreover, if you adopted a strategy of selling a small percentage of your appreciated VOO shares annually, say 3 to 4%, that could generate a very substantial passive income stream from a much larger capital base. This relies heavily on market growth continuing robustly. The critical distinction is between direct dividend income and income generated from total return. SCHD is designed for the former. VOO excels at the latter, requiring a strategy of selling shares to realize income from capital gains. For a pure, hands-off recurring cash payment by 2030, SCHD presents the clearer and more direct path to higher dividend payments. Ultimately, the choice between VOO and SCHD isn't about one being inherently better than the other. It's about aligning with your specific financial goals and risk tolerance for 2030 and beyond. If your primary objective is to maximize immediate growing cash flow directly into your bank account without selling shares, SCHD is likely your champion. Its explicit focus on dividend growth stocks makes it ideal for income-focused investors, particularly those nearing or in retirement, or anyone building an income-centric portfolio. The predictability and acceleration of its dividend payouts are incredibly compelling. On the other hand, if your goal is long-term total return, prioritize on capital appreciation and willing to accept a lower direct dividend yield, or if you plan to generate income by selling a portion of a much larger appreciated portfolio, then VOO is the stronger contender. It offers unparalleled diversification across the largest USX companies and historically provides robust capital growth. VOO is often favored by younger investors with a longer time horizon who are accumulating wealth and can defer income needs. Many savvy investors don't choose one or the other, they blend them. A portfolio that combines VOO for its broad market exposure and capital growth, with SCHD for its strong growing dividend income, can offer the absolute best of both worlds. This hybrid approach allows you to benefit from the overall market's upward trajectory, while simultaneously enjoying a robust and increasing stream of dividend payments. Consider your timeline, your need for immediate income versus long-term wealth accumulation, and your comfort with market fluctuations. Both VOO and SCHD are excellent low-cost ETFs, but they serve different masters. By 2030, SCHD is positioned to deliver a higher direct dividend income stream, while VOO is positioned to deliver higher total portfolio value from which income could be drawn. Deciding between these financial powerhouses requires careful consideration of your personal investment objectives. What's your income target for 2030? Run these scenarios for your own portfolio. Do the calculations. Which strategy resonates most with your vision of financial freedom? Share your preferred strategy in the comments below. Are you Team VOO for capital growth, or Team SCHD for dividend income, or perhaps a smart blend of both? Let's discuss how you're building your passive income empire.